All right. Five, four, three, two, one. On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and I am joined by Sam Stovall. He is the Chief Investment Strategist at CFRA Research. Sam, I got to say, we had a wonderful quarter. We started the third quarter thinking that we were going to have a bear market. Here we are just at higher highs in the S&P and the other indices. What are the indicators right now that are going to telling you to tell investors that Q4 is going to be exactly the same?
Well, first off, Todd, good to see you. But everybody knows that Q4 is typically a pretty good quarter, the best of all four quarters, not only in terms of average price change, which typically exceeds 4%, but also the batting average, the frequency with which the market has risen. And that has averaged about 80% of the time. So the first question that investors give me is, well, gee, Sam, we had August and September see positive returns for the S&P 500. Does that mean we will be stealing from Santa? Meaning that we will probably not have a good Q4 because August and September were up, even though they're normally down? And the answer is no. Every time that happened, on average, we got a similar 4+% rise in the S&P in the fourth quarter and a 80% frequency of advance. So no, a positive August and September did not steal from Santa. Second, we have had 89 new highs for the S&P 500 this year, and only recently did we see a new high for the Russell 2000. So what does that mean? Well, the Russell is now playing catch up, but typically whenever that occurred, the small cap index posted a 2.5 to 1 outperformance of its typical 3-month return, and also saw a significant improvement in its batting average. So mainly, yes, small cap stocks are likely on the recovery because they have joined the club of new all-time highs and are probably kicking in the octane right now. And then lastly, the S&P itself, because it has posted a new high along with the diversified developed international indices. That too has led to a superior 3-month return combined with a better than average batting average.
So it sounds like, I mean, there's so many great things that are happening right now to fuel the bull rally, including, like you mentioned, small caps, monetary policy. We have an easing policy right now. Wall Street got exactly what it wanted last week. And then the indication we're going to have further rate cuts in the final two meetings, which, as you know, is great for small caps. But with everything coming together so well, has there ever been a time in history that you can remember where everything has been so great that there's really nothing that can cause a bear market?
Well, nothing that can cause a bear market, but certainly we could end up with some digestion of gains. Let's face it, we are moving into October, and October is the most challenging month of the year, where its volatility is about 1/3 greater than that for all 11 months on average. So
Hmm.
I would say tighten your safety belts. We are looking at very strong results right now. And if you had to, yeah, you could probably come up with reasons that the market could be upended, such as we see a precipitous fall in the hiring data, we see a jump in the unemployment data. So jobs is the big concern right now for the Fed. And I think that's why they're likely to cut rates in October and December, and then probably 2 times in 26, not the one time that the dot plots are showing. Also, if we're looking at earnings growth, yes, we are coming back to what the growth expectations had been at the end of 2024. We were looking for about a 13% rise in earnings for the S&P 500 as of December 31st of 24. Now that estimate is about 9%, certainly better than where it was at the end of June, but we still have a ways to go just to get back to what we were thinking at the beginning of this year.
So has the bar, speaking of earnings, has the bar just, is it too high for some of these companies? JP Morgan kicks it off on the 13th of October or 14th of October, I'm sorry. And so along with Bank of America and Wells Fargo, but do you think that analysts might have moved the bar a little higher now? We could prevent some beats?
Well, that's a possibility, but I think management continues to do a very good job of managing expectations. We just recorded the 63rd out of the last 65 quarters in which actual results exceeded end of quarter estimates.
Wow.
And this quarter, so the Q3 of 25, S&P Capital IQ is projecting a 7.2% increase in year over year earnings. That's up from slightly from the 6.8% that was anticipated at the end of June. Yes, we are looking for some red ink. Energy stocks likely to show a 6% decline. Also looking for 3% declines in both consumer discretionary, consumer staples, and a slight decline for healthcare, but most of the gains are going to come from the usual suspects. Information technology up 21%, industrials up 10%, financials 9.5%. So still good growth expected, and I would not be surprised if we see that bar raised as time goes on.
Sam, let me get your opinion on something. And that we're not talking politics here, so I'm not going to say that this came out of the White House, but the president did mention something about having or removing companies from having to report quarterly, maybe have earnings reported maybe semi-annually. Do you see that as a positive or a negative?
I think that from an investor's perspective, it's probably more of a negative because certainly the retail investor already thinks that they are behind the eight ball when compared with professional investors having pipelines to corporate management. So, with investors getting information twice a year rather than four times a year, that means that for an extended period of time, they're going to be trading on pretty old news. So I
Hmm.
would tend to say that Wall Street wants as much information as possible. And if the old academics say that everything that is known is already factored into the markets, well, you're going to probably have a lot more volatility because now there will be that many more unknowns that investors have to deal with.
Yeah, that's a really good point there. So let's turn the page here to the macro data. We have a number of key reports coming out this week. You mentioned the labor picture, where we'll have the jobs report coming out the first Friday of October. But this Friday, we have the PCE number coming out, a real big inflation gauge that the Fed really tries to capture as far as their determination on interest rates. Do you see this time around, though? Do you think the PCE number may take second fiddle to that labor report, as it seems the labor report is much more important?
I think so. And also because we've already heard data from CPI and PPI that with the PCE coming out at the end of the month, it does not get as much attention as the CPI does when it comes out. Our expectation is we're likely to see equal to or slightly higher numbers this month as compared with last month when you look at the headline and core month over month and year over year. In particular, the year over year core is expected to be up to 3% versus last month's 2.9. And I also caution investors we could see that number hit 3.1%
Hmm.
in the next couple of months before starting to edge down once again. So inflation still remains fairly sticky and could present a bit of a headwind.
So on top of that, then let's start talking about real estate because you also have existing home sales and new home sales reports coming out this week with the Fed cutting rates. I know it's way too early, and plus the long end, we have to start seeing rates come down, especially on that 10-year, to help mortgage rates. Do you see this though as an opportunity to get into a beaten down sector such as real estate?
Well, real estate really has been beaten down. You're correct. A lot of it has to do with just the inventory is not out there. We do think that existing home sales numbers will fall modestly in August to 3.98 million annualized units from the 4.01 million units seen in July. New home sales could rise modestly, though, up to 660,000 units from the 652 in July. So new homes are starting to pick up. Existing homes, well, interest rates still remain a problem, especially when you think about the people who still own their homes at very low mortgage rates. Do they really want to be swapping for still high mortgage rates?
Yeah, it's a good point then. And one other macro data point that's coming out this week is second quarter GDP. Care to pick a number for, and will it move the markets on Wall Street?
I do not think that it'll move the markets. If it doesn't come in at the first and the second revision of 3.3%, we think maybe it'll show a 3.2% climb, but that's not a big deal. But when you do look to the next two quarters, Q3 and Q4, we think it'll be showing about a 2.1 and 2.0% respectively, with the first half of 2026 coming in at a similar 2%. So the economy remains fairly resilient. It's the jobs picture that I think the Fed will continue to focus on.
Okay, that does make sense. So, final question for you. We're going into Q4. Obviously, a big consumer obviously will be spending a lot on the holidays just because we saw the numbers come out for back to school shopping, which tends to be a proxy for a more healthier and robust retail spending season. But is retail an area that you see that could be in favor right now? And are there any other themes that you would maybe suggest for investors?
Well, it seems as if when you're looking for the winners, it's like being Captain Reno in Casablanca, round up the usual suspects. It's communication services, it's technology, it's financials that are expected to be the outperformers because really that's where the growth is or the benefit from lower interest rates. Sure, you could see some improvement in consumer discretionary, but they are dominated by Amazon and by
Hmm.
Tesla. So unless the picture improves for Tesla, then we probably are going to continue to see a little bit of lessening of the broadening expansion in the consumer discretionary category.
Yeah, that's a great point. Well, we will see. Well, I know for one thing that's for certain, we'll definitely have you on the other BTT shows well before the holiday season so we could get into this a little bit more and further expand on it. So, Sam, thank you for joining me on the Money Path. I can't wait to have you back again to talk more about the markets.
Thanks for inviting me, Todd.
Absolutely. So, on behalf of Sam Stovall at CFRA Research, go to CFRAResearch.com for more. And I am Todd Schoenberger. Thank you for joining us on the Money Path. We'll catch you next time. Take care.
Good job. You should do this for a living.
I appreciate it. I should, right?
Yeah.
I know. I know. I just have to get